Foreign direct investment, FDI, in China falls by 50%, marking the biggest drop in 25 years. New car sales lost 138 billion yuan. China Automobile Association submits emergency report. Foreign direct investment, FDI, in China falls by 50%, marking the biggest drop in 25 years. According to data released by the Ministry of Commerce of the Communist Party of China, from January to August this year, the amount of foreign direct investment, FDI, actually utilized in China fell by 31.5% compared to the same period last year, and the dollar value decreased by 33.8% year-on-year. During the same period, the scale of foreign capital leaving the country through primary and secondary income channels reached $226.9 billion, an increase of 73% compared to 2019. On September 14, the Ministry of Commerce of the Communist Party of China reported that the amount of FDI in the first 8 months of this year was 580.19 billion yuan, equivalent to approximately $81.713 billion, reflecting a year-on-year decrease of 33.8%. According to financial creator Mars Macro, a certified senior statistician, economist, and former external professor at the School of Economics of Yangtze University, the cumulative amount of FDI from January to August, minus the data from January to July, indicates that approximately $5.8 billion in FDI was recorded in August, representing a year-on-year decrease of 50.4%. This marks the largest drop in such data collected by the Bullwriter Research Institute since 2000. In August, FDI fell to a level lower than that of August 2004, 21 years ago, when FDI was $62.1 billion, including $6.1 billion in August. While FDI is declining, foreign capital outflows are increasing, including from technology companies like Apple, Samsung, and Intel. From the Foreign-Related Receipts and Payments table released by the State Administration of Foreign Exchange of the Communist Party of China, it shows that in the first 8 months of this year, the scale of funds leaving the country reached $226.9 billion. Mars Macro expects that the total for the year will exceed $340 billion, an increase of 73% over 2019. As for the reasons behind the outflow of foreign capital from China, Mars Macro cites several factors. First, political factors are at play. The degree of openness of commodity liquidity has regressed. In recent years, state-owned capital bidding has generally excluded private and foreign companies, and the opening of the service sector has been delayed. Second, the rapid development of state-owned enterprises has made it difficult for foreign companies to maintain normal profits due to unfair competition. Additionally, the regulatory trend of administrative agencies has become overly stringent in recent years. The focus of the authorities' administrative agencies has shifted from development first to safety first, or risk minimization first. This change has resulted in numerous policy implementation deviations, significantly negatively impacting the independent operations and fair competition of private and foreign enterprises and dampening their investment enthusiasm. Geopolitical factors are also a key reason for the outflow. In this regard, netizen Sticking, Jian Yexing, expressed a similar view. Before, we were free to operate, focusing on economic construction and development first. But the situation is different now. It feels like everyone's hands and feet are tied. Previously, everyone talked about development together, but now they discuss more about how to ensure safety and security. Only love special education, remarked. The mask operations in the past few years have directly hindered people outside. In a city with a population of over 20 million, you can't go out if you're not allowed. People have committed no crime. Why should they be locked up at home? Who would dare to come under these conditions? New car sales lost 138 billion. Yuan China Automobile Association submits emergency report. From January to August this year, the price war among Chinese auto companies resulted in a cumulative loss of 138 billion yuan in the overall retail market for new cars, leading auto dealers to face the problem of a broken capital chain. Recently, the China Automobile Dealers Association submitted an emergency report to the Chinese Communist Party government. Auto dealers face a broken capital chain. According to the official microblog of the China Automobile Dealers Association, the association has recently received significant feedback from member companies indicating that the drastic changes in the automobile market, driven by the ongoing price war, have left auto dealers deeply trapped in a quagmire and facing the pressing issue of extremely tight capital liquidity. The association promptly conducted research and analysis to comprehensively reflect the current financial difficulties and closure risks faced by auto dealers. China Automobile Association submits an emergency report. Recently, the association formally submitted an emergency report on the current financial difficulties and closure risks faced by auto dealers to relevant government departments. The report pointed out that current new car sales by dealers have suffered large-scale losses, resulting in a general cash flow deficit and increased risk of a broken capital chain, making it challenging to escape the survival dilemma. There are two major issues at this stage. First, the dual pressure of sluggish consumption and manufacturers' wholesale volume has kept dealers' inventory at a high level. To alleviate capital pressure and financing costs, dealers are compelled to sell at low prices just to survive. Second, the price war has caused a serious inversion between sales and purchases. The more dealers sell, the more they lose. Concurrently, they are facing difficulties in fulfilling financing contracts. Dealers are experiencing cutoffs in operating funds and a sharp increase in the risk of capital chain rupture. Currently, the maintenance time of dealers' existing working capital has been compressed to the limit. From January to August, the new car market lost 138 billion yuan. According to the association's Market Pulse monitoring data, as of August this year, the highest inversion of dealers' sales and purchases reached negative 22.8%, further expanding by 10.7 percentage points compared to the same period last year. Experts' relevant data analysis indicates that, in August, the overall discount rate in the new car market was 17.4%. From January to August this year, the price war has led to a cumulative loss of 138 billion yuan in overall retail for the new car market, which has significantly impacted the healthy development of the industry. The association has called on relevant government departments to pay close attention to the current financial difficulties and closure risks faced by the automobile distribution sector, and to adopt phased financial relief policy measures to prevent systemic risks in the automobile distribution sector. Earlier, on August 28th, China's largest automobile dealer, Guanghui Automobile, was officially delisted from the Shanghai Stock Exchange due to its stock price being below 1 yuan for 20 consecutive trading days. On the day of delisting, its market value was only 6.471 billion yuan. Guanghui Automobile has repeatedly stated in its financial reports that the price war has profoundly impacted the automobile distribution industry, and Guanghui Automobile is under significant pressure once again. Sales slow down and price wars intensify. Due to overcapacity, Chinese automakers are engaged in price wars. At the beginning of 2023, the price war started and subsequently intensified. According to data from the China Passenger Car Association, cumulative sales of new energy vehicles in the first 7 months of this year reached nearly 4.99 million, a year-on-year increase of 33.7%. In comparison, the increase during the same period in 2023 was 36.2%, while the increases in 2022 and 2021 exceeded 90% and 100%, 160% respectively. It is worth noting that this year's growth in new energy vehicles primarily relies on plug-in hybrid vehicles, which saw a year-on-year increase of 71.6%, totaling 2.08 million vehicles. In contrast, the year-on-year increase for pure electric vehicles was only 15.5%. Data from the China Passenger Car Association also showed that retail sales of new energy passenger vehicles in August were 1.027 million units, representing a year-on-year increase of 43.2%. Retail sales of new energy passenger vehicles from January to August totaled 6.016 million units, with a year-on-year increase of 35.3%. According to data provided by Elov Jinghong, an intelligent travel analyst at Bloomberg New Energy Finance, the average price reduction of new energy vehicles in China has risen from 6,700 yuan in the first quarter of last year to 16,000 yuan in the first quarter of this year. This increase has resulted in the weighted average selling price of new energy vehicles in the first quarter of this year being almost the same as that of traditional fuel vehicles. Notably, 2/3 of new energy vehicles on the market are priced lower than fuel vehicles of the same category. The Daily Economic News reported that the price reductions for new energy vehicles have outpaced the slowdown in sales growth, indicating that this year, the price war in the new energy vehicle market has intensified.
Economists warn China's economy is slowly collapsing. 51 of the 74 analysts tracked by Bloomberg estimate that China's economic growth rate in 2024 may be less than 5%, with some economists even warning that China's economy may slowly implode. Over the past 2 years, the real estate crisis has dragged down all aspects of China's economy, from the job market to consumption and household wealth. The measures taken by the authorities to restore investor confidence have been too slow and too small, resulting in a long-term slump in China's stock market. The CSI 300 index, which tracks China's onshore stocks, has fallen 4.2% so far in 2024, marking the fourth consecutive year of decline. In contrast, the broader Asian stock index has risen by nearly 10%. Furthermore, the impact has spread to broader financial markets, affecting individual investors. According to a report by mainland media China Securities Journal on Thursday, August 29th, nearly half of the 27 closed-end 3-year mutual funds launched in 2021 are facing losses of more than 40% near the end of their cycle. Bloomberg reported that Alpine macro strategist Wang Yan, who recently returned from China, believes that the 5% economic growth target is almost impossible to achieve. He also warned that China may be at risk of a slow implosion in the future. He noted that Chinese policymakers lack a clear and coherent strategy to address these challenges, and even the piecemeal measures currently promoted to solve demand problems are temporary and hesitant. Global major banks agree China cannot achieve 5% growth. UBS Group lowered its forecast for China's economy on Wednesday, the 28th, stating that it is increasingly unlikely to achieve the goal of 5% economic growth this year. The Swiss bank reduced its forecast for China's GDP growth this year from 4.9% to 4.6%, and its growth in 2025 from 4.6% to 4%. Previously, JP Morgan and Nomura Securities also set China's economic growth forecast for this year below 5%. Bloomberg noted that this reflects a consensus among major banks around the world that China may not be able to achieve its annual growth target, even though the top level of the Chinese Communist Party continues to promote its commitment to achieving economic and social development goals. The downturn in the real estate market has severely affected domestic demand and confidence. We expect weak real estate activity to be a bigger drag on the overall economy than earlier expected, including affecting household consumption, UBS economist Wang Tao wrote in a report on Wednesday. UBS stated that the measures enacted by Beijing since the end of 2022 to revive the real estate market, including lower down payment requirements, lower mortgage rates, and fewer restrictions on home purchases, have been slow to take effect and have had limited impact. They expect China's new real estate starts to bottom out only in mid-2026. In recent years, China's real estate supply and demand fundamentals have changed, with low market confidence, high inventory levels, and slow destocking amid weak household income growth, the UBS report stated. China's banking industry is in a bad state, and many banks are required to tighten their belts. China's economy is in decline, and the once highly regarded banking sector, known for its high welfare and wages, is now facing challenging times. On August 31st, the topic of many banks living a tight life trended on social media, sparking heated discussions. Public data shows that as of the end of the first quarter of 2024, the net interest margin of commercial banks had fallen to a record low of 1.54%. Data from Oriental Fortune Choice reveals that in the first quarter performance reports of 42 A-share listed banks in 2024, approximately 15 banks experienced a year-on-year revenue decline. A corporate business staff member at a joint stock bank mentioned that this year, the salary structure across all positions in his bank has been uniformly adjusted, with some year-end bonuses canceled and moved to monthly performance wages. An employee at a large bank shared that the bank has become more frugal with office supplies, printing materials only when absolutely necessary, and preferring electronic documents. If printing is required, both sides of the paper are used. Now, fewer meeting materials are printed. We rely on electronic versions whenever possible, said an employee of a city commercial bank. The bank follows the principle of living a tight life in all aspects, requiring neighboring counties to share vehicles for business trips and training sessions. Another large bank employee stated, "We are also tightening our belts from top to bottom." Fuel expenses for the bank's public vehicles have been halted, and external marketing activities are now subject to certain restrictions. Moreover, semi-annual collective welfare expenses and labor protection supplies have also been affected. An employee from a large bank noted that employee benefits at various banks have been reduced to varying degrees. The bank where he works has made noticeable changes, from reducing the summer water supply standards at business outlets to cutting training costs and shifting to online training to save money. As China's economy continues to decline, more banks are going bankrupt, merging or restructuring, accompanied by layoffs and salary cuts. Data released by the State Administration of Financial Supervision of the Communist Party of China in August this year indicated that at least 50 small and medium-sized banks have been dissolved since the beginning of the year. Except for one city commercial bank, Korla Bank, the rest were rural small and medium-sized banks. On August 20th, China Kalian reported that several banks, including Nanjing Bank, Ping An Bank, Pudong Development Bank, and Shanghai Rural Commercial Bank, released their 2024 semi-annual reports. According to Oriental Fortune Choice data, the number of employees at Nanjing Bank, Ping An Bank, Pudong Development Bank, and Shanghai Rural Commercial Bank decreased by 4,116 in the first half of the year,